Hey everyone, it's Tom here, and today we're going to cover a topic that comes up occasionally when I speak to traders, and it's usually one of those things that most traders have heard of, but they don't quite understand, they don't see how it could work, but people tell them how this is a great thing to look at, and that's scaling. We're going to talk about both scaling in and out of trades. We're going to cover what scaling is and where the advantages and disadvantages lie. This won't be a recommendation on applying scaling into your trading, or if you are scaling, it's not going to be a warning to say don't take it out. I'm simply just going to give you both points to show you, where it might be useful and maybe where to steer clear. So yeah, guys, we'll get straight into it. Just very quickly before we dive in, if you're still struggling with your trading, or you'd like to know more about how mechanical hedges are traded, I've put together a free video course for you that'll map out and explain everything in detail, along with walking you through exactly how the mechanical rules actually work. If you'd like to watch that after this video, I'll pop a link in the description. You can click through and you can watch that straight away. So let's start by covering what do we mean by scaling. So on a standard trade, we would usually set one entry position, using our risk management rules, have one stop loss and one profit target, one limit. Scaling allows us to either gradually build a position or gradually exit a position in stages, or potentially both as well. And as a result of that, it comes with some advantages and disadvantages. So first thing really traders that support scaling say is that it allows us to kind of have greater control over our risk management. For example, when you're scaling in, you can build a position as the market keeps moving in your direction, so you can be more sure that, if you're using a trend, it's going in the right direction. Also, by scaling out, we can look to take partial profits, kind of ensuring that maybe we break even, we cover our entry position, and then holding the remaining of our position for larger profits to let the trade run. Obviously, this comes with disadvantages as well. We're going to sacrifice R potentially when we're scaling out or we're scaling in. So, if we enter with just one position and one profit target, we have that set R. Entering multiple trades as you scale in slowly, if we're using the same profit target, gradually that R is going to be diminished by every additional trade we place. By scaling out, we can balance that a little bit, of course, by letting it run. But overall, it can erode the R unless you aim to go for longer holding trades and obviously slightly riskier profits there. So we'll start by looking at scaling into a potential trade. I'm just going to use this general example here. This isn't a trade that I've taken. We're just going to have a look at a pound-dollar chart here and imagining we're going to say, let's have a look at, we would take trades when they're breaking through potential support or resistance lines. Like I said, there's not a lot of analysis gone into this particular example. I want to show you kind of the effect of maybe looking to scale in and also to scale out here. So we're not necessarily focusing on the strategy rules at all here. So let's imagine that, we've got this recent setup here from early Feb. I'm just going to mark this on as a potential support line and just say it roughly there. As you can see, we've got a couple of bottoms here. It's moved up quite quickly and then come back down here on the 2nd of Feb. So we sell when the market breaks underneath this line, just as a very general rule. But how confident do we want to be that we've broken through the support line? Well, we could look to take our first trade at this candle here as it closes underneath this support line that we've drawn. But, do we have a huge amount of confidence maybe in the fact that, it has actually successfully broken the support, it's going to head lower? Possibly not. So we could take our first trade there, but instead of using our full 1% per trade risk management that we would apply, let's say we take 0.25%. We're going to look to scale in 4 different steps. So we take our first trade there. It's slightly riskier because we don't know that it's broken support fully yet, but we're going to get in at the earliest possible opportunity. We do that and we have a look at where the market's going to go. Well, maybe our stop loss is somewhere kind of up here around maybe these resistance zones. Again, not super clear in terms of what I'm looking at for strategy rules, but the purpose here is to look at the scaling in and scaling out process. So we say that we have a little bit of a reversal here, but then it dips below again. So maybe our second point is to say we're going to get in on the reconfirmation that it's broken underneath. And so we may be getting on this candle here or maybe this one as it heads slightly lower. That's our second entry again we look to add to that position another 0.25%. And then we're going to look again to see, does it head further? How far down is the market to go? Can we scale in at future opportunities when we see that we're really on a strong downward trend here? So potentially we wait and say, okay, we're actually going to get in again at an opportunity when it's clearly broken through and we think there's some momentum in the market here to go lower. So it may be around this area here. Again, very general in terms of what I'm looking at, but hopefully you can see the opportunities there where instead of putting kind of all our eggs in one basket, so to speak, and our first entry up here, we're waiting for that extra confirmation to see that we are heading downward and we can continue to add to our position. Finally, we might wait again, see if there's a bit more of a reversal and then get in. So it could be somewhere down here, for example. I mean, eventually the market does take a huge drop down. But, at this point up here, we're still unsure about, has this fully broken the support? Have we got our support level exactly right? Again, my line here is very, it's very vague. Not really any analysis it's gone into that. But hopefully it illustrates the point that instead of getting in and putting all the risk in there, because if this had come back up, and gone back up to these highs, to this resistance area, instead of, risking our full 1% on that trade that we weren't sure if it had broken support yet, we're only risking 0.25%. So, the risk is quartered basically. And therefore, we can be more sure as we add the position, as we go further down. We are going to sacrifice some risk, obviously, but when I say we're going to sacrifice some risk, we are going to sacrifice some R. So, the profit target returns won't be as high as if we got all in on this single trade entry here, but we can be more sure that we're moving in the right direction. Let's look at one more example in terms of scaling into our trades. So we've got here US 30, just going to draw again a very crude support level again, and we're going to look at what happens maybe if, we don't get that winning opportunity. So very simple setup here, again, support level, we wait for it to break underneath. This would be our potential entry signal here as we get a close across that line. And as I said, very simple approach. If we take that trade with our full risk management, say full 1%, maybe our stop loss is up here, for example, we're going to get stopped out and, we've had a false breakout there, basically. The market's reversed. It's not really fully committed to breaking through that support level. Other way, if we look at it with, a scaling in approach, then, okay, we've tested it, we've got in at the earliest opportunity, but, if we're going to use that same rule we did for the first example, maybe 0.25% per entry, we test the waters, we don't commit fully in terms of our full risk management on this potential entry, but we're waiting to see if this is the beginning of a move further downward or, further upward if we're going to look for a resistance level. So hopefully you can see by the example before and this one, kind of the two ways that we can look at using scaling into our advantage. We can test the market to see, okay, if we're looking for a slightly riskier entry, we're not too sure if, we're going with the trend, for example, then it can be a really advantageous way to protect ourselves on those higher risk trades. So with that being said, guys, let's have a look now at the other side of it, which is scaling out of trades. So to analyze scaling out, I'm going to go back to the example we used a little earlier, and we're going to have a look at this GBP USD, this pound dollar setup here. So for simplicity's sake, let's just imagine we have the single entry. We won't look to combine the scaling in and scaling out discussion here because it may get a little overwhelming, but let's talk about a very fixed entry point and what do we do in terms of scaling out as opposed to a single profit target. So again, let's say that we have our initial entry point is on the second confirmation of a break. So this candle here, and we have our stop loss maybe up here, and we have let's say a 2R profit target. So if we're going to check that through, obviously up to stop here would be about 5.71. So we'd be going down to around here for a 2R. I'll tell you what I'll do to make it easier. We'll mark it on as a short position so we can see and easily work out that 2R target that we've got. So we pull this down and we're going to be about there for our 2R target. So you can see it's taken a little bit of time, but it's come down and hit. But obviously we're in the middle of this fairly strong downtrend here. So can we take advantage of this? Again, by protecting ourselves maybe from too much risk and too wide a profit target. So Could we look at this and say, okay, well, if we're taking one single entry and maybe we're taking it, say, on a 1% risk management rule, then how can we scale out effectively to take the most out of the market, but also protect ourselves from just getting stopped out by being too ambitious, basically? So one way we could do this is to say, well, instead of taking a 2R target here, what we're going to do is we're going to scale out in 2 stages. The first one is we're just going to aim to get break even. So we're going to basically employ a process to say 50% of our position is going to be closed for, well, when it hits a 1R profit. So, that would be up here. And then we can say, okay, well, we've got a little bit of profit back. And instead of going for a 2R, say, we're going to aim to run it for maybe a 4R, for example, which if we come all the way down here, it's just about hit right now. So we can see there, in very simple terms, we've gone for our first exit is going to be a small win. So, it's going to be a 1R with half a percent of risk taken out. So we've not quite broken even yet, but it's protected us a little bit from a full drawdown. And then we're going to go for a wider target, hope that the trade continues to run there, and that's going to get us the bulk of our profit. Again, very simple example this, again, using really simple strategy rules. It's not part of any strategies that we trade here at WB Trading, but hopefully it's an example in terms of how we would look to apply and scale out of a trade if we think that there is potential for the trade to keep running, but also if we want to protect ourselves. Another way we could do it is literally to just say, if you weren't sure about a particular target you wanted to go for, we could say, instead of doing that, let's go back up to the 2R, which was here. And we could say, look, we're going to get out, we're going to close 50% of our position at that point. So it's basically going to take us to break even if we close that. And then we're going to just let the rest of the trade run. We're going to close it manually when we think maybe there's a turnaround in terms of that trend. So it allows you to take, the profits that you've made, or at least, take your return back by closing the trade or the first 50% at break even, and then letting the rest of the trade run. Not risk-free, because I hate that term risk-free, but, you're not thinking the whole position is at risk anymore. And of course, we can scale out more than twice. Just like scaling in, obviously the more times we look to scale out or scaling, the more complexity we add, and it can get a little bit overwhelming. But in place of just having a single exit point there and relying on the market to hit a single level or a single R, we can look to protect ourselves and also let the trade run if we think it's got more momentum in it. So I'm hoping that was really helpful in terms of understanding how scaling works, potentially how you can use it to your advantage in your trading, and also a couple of the areas to look out for. See online a few times that scaling is great, etc., and sometimes traders don't explain the potential disadvantage. So it's worth trying out, it's worth demo testing or forward testing, but consider both sides of it. With that being said, guys, I hope that's been really useful as always. Thank you for coming along. Hopefully we'll see you on the next video. If you'd like to book a call in with one of our team, talk about this in any more detail or how we trade, how we can help you, links are in the description as well. And I'll see you on the next video.